This video is about the TCS results for FY26. The company concluded FY2026 as a volatile macroeconomic landscape, which was characterized by intensive geopolitical conflicts and persistent interest rate uncertainty. While institutional investor companies' ability to defend and expand its operating margin to 25%, a 4-year high, is a signal of structural resilience and good cost management. This 25 threshold represents a normalized margins. The management was able to successfully navigate several one-way headwinds, including severance-related expenses, legal provisions, and initial impacts of the new India wage code. By maintaining the signal level of profitability, TCS signals a robust dry power position to fund its build partner acquired strategic framework without diluting shareholder value. The full year financial performance reflects disciplined execution in a very pressurized environment. Despite a contraction in constant currency, the firm is gravitating towards high value AI integrated delivery models have stabilized the bottom line. Revenue for FY26 was 2,67,021 crores, up 4.6%. Revenue US dollars was 30.17 billion, down 0.5. Revenue constant currency was down minus 2.4. Operating margin marginalized 25%, up 70 basic point. Net margin 19.8 expanded. Revenue EPS was up 8.8%. The 70-point expansion was driven by a favorable currency tailwind, 110 basic points, and continued operation to value-led delivery. There was an aggressive reinvestment strategy. 40 basic points were absorbed by external consultant costs to bridge delivery across internal capacity scaling. Another 40 basic points were delivered direct towards talent upscaling and India wage code. Additional 50 basic points were invested in GTM activity and ecosystem partnership, particularly with OpenAI and NVIDIA. The margin discipline provides the requisite capital to transform a pure play service model to infrastructure to intelligent partnership essential current period. The cautious investment total contract value has surpassed immediate revenue, the lead indicator of the company's long-term visibility. TCS record for $40.7 billion FY26 TVC supported by 5 mega deals underscored a clear vendor consolidation. Clients are preferring abounding fragmented service providers in favor of trusted partners. There are three Marco revenues and expansion. Marks and Spender, a long-term partnership renewal demonstrating high retention and deep contractual. UK telecom operator, a 5-year consumer business transfer consolidating a landscape previously managed by multiple, and a US healthcare and pharmaceutical traders. A cloud native reactor of a claims platform processing 5 million daily prescriptions. Interestingly, this deal delivered measurable ROE by compressing client cycle from 48 hours to just 12 hours. Various vertical performance, BFSI spending has matured from speculative investment in experiment to industrialized business transformation despite rate uncertainty. Clients prioritize core modernization regulatory reasons. Manufacturing, the performance was resilient right through, but there were headwinds from recalibration of EV demand and restraint in capital and expenditure in automobile industrial segment. Growth was sustained via AI led to predictive maintenance, ERP moderation. Consumer business led by retail and TTH in UK and EMA through North American CP segment and showed weaknesses. CPA communication, media and information recorded a modest decline. Through momentum is returning as the telecoms return to pay a dividend object to offer searching. North America was stable up 1.4% quarter on quarter, UK 2.4 quarter on quarter, setting a solid foundation for industrialization. Regarding AI strategy, company has transform from experimental to scaled industries. Get AI ready, core moderation, US car rental, migrated 20% plus legacy to modern play, decommissioned legacy system, delivered for 2.5 million in European airline, led with RI business imagine, steel major, electronics matcher, and service now in NVIDIA are designed to compensate. Specifically, the OpenAI Alliance focus on empowering Tata Group companies with Chat GTP Enterprise, serving as customer zero, tested before global. Then the hyper-valued strategic deep dive. Hyper-valued represents a transformative shift to our full-stack infrastructure to intelligence foundation by targeting 1.1 GW of capacity. TCS mounting to the traditional integrated role, the physical layer of AI. This ownership reduces dependency on traditional hyperscale margins and allows TCS to capture new revenue streams in high density AI overload market, typically in the 100-200 MDW range. The hyper-value ecosystem and synergies include EPC and physical layer, global alliance, which includes partnership with ABB, GE and Siemens, which provide the cooling and control system necessary for high density environment. Helios architecture, this proprietary rack cycle architecture is specially targeted at designing high density AI capacity in India, capitalizing on domestic sovereignty trends. The compute commitment, the 100 million capacity partnership with ON positions TCS as a tier 1 infrastructure for frontier models. Operational ready in human capital. The company had 5,84,519 associates in 149 countries. Upskilling department, 69 million learning hours completed with 2,78,000 associates who now possess advanced AI MI proficiency. Operational tools, nearly 50% of internal resource allocation now managed by the internal talent marketplace, which uses AI to optimize rational rates and reduce lateral costs, hiring costs. Retention strategy, combat attrition in natural. TCS announced annual salary increments effective April now, with top performance receiving double-digit increases. By maintaining top employer state, the 11th year TCS ensures the stable talent stability required for the complex multiplex currently dominating. The company has declared a final dividend of 31 per share, bringing the total payout to 110 per share. The company's financial year 26 performance reframes its position as a defensive play in the choice in the IT service sector. Its ability to expand margins while aggressively investing in the hyper-value infrastructure suggests the management team that is prioritizing long-term market share over short-term value stream. Company generated healthy cash from operations at $1.6 billion, representing 106% of the outlook for the management is positive and confidence for FY27 is supported by record TVCV exit rate and rapid scale of industrial AC revenues. The company's 5-pillar strategy stands to full stake AI player provides a comprehensive mechanism to navigate outgoing macroeconomic geopolitical certainty. By virtually ethically integrating from infrastructure to intelligence, Agentic AI, TPI is uniquely poised to deliver sustainable long-term value to institutional shareholders. Please subscribe to our YouTube channel for regular equity investment updates and also other cricket news. Thank you.